How's everyone doing today? So this is a pretty quick lesson I want to talk about. One thing that always has irritated me about searching something on YouTube is that they give you a really good broad definition, but never that great of specifics, especially on this topic. And so today we're talking about sector rotation. Everyone's favorite. I know a lot of folks are super excited about sector rotation. Oh my goodness, I'm just so involved. We all know that's not really, right? But this is something that's really important. As you go through your trading experience, day trading, scalping, swinging, long-term investments, you're going to see that there's sectors, 8, 9, 10, 11 of them, depending on which ones you want to focus on, that are really going to be crucial to you. And as we go through this, I'm not saying that there are certain sectors that are better or worse. All I'm saying is that there's some things you should bring into consideration while picking the stocks you want to pick. The reason is that during certain times of the business cycle, things are going to change and you can get better deals on certain things, but then also anticipate what sectors may be doing good next. Now, there's some that are going to outperform anyways, depending on the situation at hand. Like, for example, technology and energy, when it comes to 2020, were huge, right? Especially with that huge sell-off. Energy is usually not doing that great, but since the EV push, it was massive. And again, today is, it's April in 2021, so you're watching this video later on, it may be completely different, and that's the whole point. If you watch a bunch of older videos, they're commenting like, well, right now we're here in the time, and that's all you have to know. Have a good one. And that's not helpful, because then you don't know how to look it up yourself. And so I'm going to show you the exact steps that I do to always, almost foolproof it, see where we are in the sector rotation. And that way you can plan your next investments. These are almost like gravitational forces, right? And this is a very macro scale. So it's like sectors, and then you kind of move down to like, your indexes. Then you kind of have your overall market structure, and then you have like volume. So again, there's a few things that kind of pull and push price where it's going to go, and it's the massive one. So no further ado, let's get into it. What you're going to see is these links, and again, maybe like, but I don't have access to these. Well, you're going to get access to them. So the first we're going to click on is this one, and it brings us to this screen right here. Now, what you're probably thinking is, what the hell is this? So what's really nice about this chart, and again, I'll share in the description box down below, is that it gives you your major sectors. Now we have technology, discretionary, consumer services, industrials, materials, energy, consumer staples, different than services, healthcare, utilities, financials, and real estate. Overall, we have 7, 8, 9, 11. That's usually what it goes with. 11 sectors right here. Now, this is what's going to be interesting, is that we have this bar graph. We'll get to that in a second. And we have this. Now, this is a really confusing photo for some people, but let me break it down for you. It's very simple. The blue line is going to be the business cycle. So this blue line is going to be how the business cycle goes. Now, again, as we know about waves and how it goes from bottom and trough to peak and top, it goes back and forth, back and forth. Now, the American stock market and business cycle is pointed upward. So it goes up, it comes down, it comes up, it comes down, right? And it's not always going to be equal. It's not always going to look like this. It's not going to be perfect, right? But we know the market goes from recessions, recovery, all the way up to the top, and all the way down. Now, with that being said, sometimes it goes quicker, sometimes it goes slower, right? So the blue line is going to be strictly the business cycle. What's interesting, though, is that the stock market does not follow the business cycle exactly. It's a little bit off, it's a little bit lagging. It's because a lot of folks predict what's going to happen, or they try to anticipate what's going to happen. And again, some folks just think some certain things, and so it doesn't follow the exact way. We have market bottom as it's starting to recess. We have a bull market as the market starts to recover. And then we can see that as the market's fully recovering, we've already been at our top on the stock market, and we start coming down to a bear market. So why is this important? When we look at the business cycle in a minute, you can then predict what sectors are going to be hot and where in the cycle we are for the stock market. And so what's going to be interesting is, as I pull up this other graph that shows that, on the business cycle, we're going to be like here or here or here, wherever we may be. What's going to be super interesting is that we can then start targeting these sectors. So what's cool about this particular one in the rotation model is that wherever we are on the orange line, those are the sectors we should be focusing, and then again, anticipating to be good in the future. So we come up here. It's a different way of doing this. This is all 11 of them, and again, they're in order. It is in order they're going to be, basically, pretty close to it. So we can see that this is going to be where we have our recovery, and like the market is coming out of a bear market going bullish. We're going to peak out around energy, materials, and staples, peak out here, and then we're going to go into a bear market and have some pullbacks, focusing these four. So what I do, and this is only what I do, and you can do this your own way too. You can take the slider and go back and forth, and we can see that it's really hard to tell what's going on. So I mean, it's like, all right, well, it looks like it's a lot over here. We come forward, this is doing bad, but this is still doing good. But then We never see a real full recovery over here until recently. So here's what I do. I go to 365 days. What you're going to notice too is that most times I'm going to look at most of these graphs in increments of 6 months or 3 months, just because I think that 30 days, 60 days, it's too short, but like, 90 to 180 days, we see some full movement going on. So let's start at 365 days. For the last 365 days, we can see that discretionary, commercial services, and technology were the best, right? These were going crazy, doing really, really well. So what I'm going to do now, we can see that energy is bad, utilities is bad, real estate. So again, we have what looks like this. We're in this area right here, right? So for the last 365 days, you would argue that we were mostly in a market bottom, right? Just because of the sell-off of the COVID. Let's go to 340 days. All right, you can see it lowered a little bit. You got a little bit lower. These rose a little bit. 320, boom. See how this is now lower? These are getting higher, which is telling us there's market shift. We're having a market shift from discretionary comm services and technology, utilities, financials, and healthcare, right? That's exactly what we're seeing. So at 300 days, we can then see these rose back up, these drop more. Okay, let's keep working through this. 275 days, ooh, these are coming down, but what's making a big move? Materials and energy went from what, negative 36 to now at 275, negative 14. That's almost 25% up. So we can see we have a movement from these three to materials and energy. Let's do 250 days. Oh, snap. How about that? We have now these three, again, lowering and coming into what? Materials, industrials, and energy. Is that an accident? Nope. And we see all the money's moving out of here into these over here. That makes sense. 225 days. Oh, snap. You can see that these are now low. These are doing well. And again, it's not perfect, right? We definitely have financials going crazy. Something must have happened, but again, the main bulk of it has moved into the middle area. And then we have 200 days. Boom. You can see this movement. See this? 180 days. We can see that now. We come over here. Where are we? We were over here. My mouse is broken. Sorry. Mouse broken. We can come over here and see that we were technology, discretionary, comm services, and now we're moving into industrials, material, and energy, which is this top right here. Sorry about that. We'll buy a new mouse soon. And then we go to 160 days. Right? We can now see that these are now much higher. 130 days. Energy. And that's a big EV push, obviously. But again, what's this telling us about the market without touching the middle scrolling button? We're peaking out. All right? And this was, again, almost 3 months ago. So 110 days, we can now see a shift. These are now dying. These are dying a little bit less than they were before. Again, let's go to like 200 days. Terrible. 100 days on the average, doing pretty well. Now let's kind of make smaller increments. We'll do like 90 days. All right, nothing too different. 80 days, nothing too different. 70 days, nothing too different. 60 days. Again, there's a huge EV push. Now we can see real estate popping off. Real estate, again, is towards bear market area. So that's going to be concerning moving forward for us on our long-term, on our short-term investments of like how the market's coming down. 50 days, financials and real estate, and now we have positive staples. These are now negative. Everything's left here. This is now only plus 15%. It's shifting. 40 days, shifting farther to the right. 30 days, boom. That's my point right there. We went from having all of our money in discretionary, which means folks spend money on shit they don't need, right, to comm services and technology, right? Now we've pushed in industrials, materials, and then energy. And now we're fully moving the last 30 days into healthcare, utilities, financials, and real estate. The next 20 days, boom. Again, that's going to become more volatile, right, because it's a little bit shorter time frame. But we can see these are still doing really well. 10 days, again, it gets kind of skewed. But again, the whole point remains for me that 365 days ago, we had these three being the biggest. 180 days towards the middle, and then the last 30 days towards the right. So what am I getting at? You should always look for a good deal. Obviously, if you like technology stocks, which many of you guys do, every TikToker and their mom is like, "Oh, technology, PLTR to the moon." Shut up, idiot. That's not how that works. So you can definitely find good deals in technology. You can find good deals in materials. You can find good deals in discretionary even now. But we're gonna focus on the markets that are doing the best. And as of right now, the last 30 days, you can say, well, actually, energy and industrials are doing the best. Sure, but again, if you look at 180 days ago, they were plus 15, plus 14, and as of recently, these were negative 13, negative 12, negative 11 to now plus. So the difference is actually plus 13 to the bear stocks and then minus for the middle stocks. So that's super interesting to look at. So what are we going to do now? So here's what we're going to do. To tell where in the market rate we are, we're going to use these 5 things. We're going to use stage, consumer expectations, industrial production, interest rates, and yield curve. Now again, let's go through each one in succession. So these links I'm going to give you, the first one's the business cycle update. Now this is a website. Again, it's not perfect. Nothing's perfect besides me. It tells you where we are. Now we can see that this is not going to be based off of the stock market. It's based solely off of the business cycle. We can see that we are towards the early recovery and almost to peaking out. Does that make sense? I think it does. Now with COVID, it may be different if you watch this video in a year, that it may be a different setup than different circumstances. But given that we had a huge sell-off in March, and now a year later we're making a huge push up, and we're kind of peaking out. Again, we're going to stop giving out money to people. Senate's not doing anything. Like when do politicians do anything, right? So we're kind of peaking out. That kind of makes sense. So let's go back over here to our main chart. Full recession, I wouldn't say so. Full recovery, early recovery, I wouldn't say so. Full recovery, we're getting there. Early recession. So again, I would put us somewhere in between stage 2 and stage 3. But I would definitely say we're towards full recovery. I'd give us maybe another month or 2. We're going to hit here. Now what's interesting about this chart though, it's not going to move very quickly. And again, sometimes it may not move the same. If we have peaking out, if we're over here, like we were in, January and February 2020, and then that COVID hits, we could be down here very quickly. So again, I wouldn't be like, oh, we have plenty of time, this whole thing moves. I'd say every month or 2, every 6 months, we're going to see a big shift. So as of right now, I would be safe to put us in full recovery or nearing it. So again, we're definitely not focusing these stocks right now. We're not in discretionary commerce technology. We're definitely going to be focusing things like consumer staples, healthcare, and utilities. And that's how it works. So full recovery, line it up, consumer staples, healthcare, utilities. Now that's only the first one. Now if we have the other 4 here are showing reviving, bottoming out, falling, and normal, well, I'd shift this more to the left over here and focus this. But on our first one, I'd say we're close to full recovery, early recovery, putting us somewhere between consumer staples, healthcare, utilities, and financials. We're in this area. The next one's consumer expectations. Now, how do you find that? Well, I have a nifty website that I use. Now, this website is going to look confusing. All right, this is going to be like, this looks like a bunch of work. Well, first thing you can see that on the right here, consumer confidence is up. You can click here and you can go into different things and pay for the premium services, where you can see that globally and we're up, and then consumer confidence is up on America. Now you can come here to consumer measures, click that, and then you can click the technical notes. And you can come in here and we can see that it'll give us some good stuff, some numbers, yada yada. I'm a picture kind of guy. I don't read books like that. And we can see that right now it even says, we can see from 2010, 2011, based on previous confidence, that our projected confidence of this time period was going to be down here, right? But we're actually coming up here. So it looks like consumer confidence is rising / almost peaking out. So let's go back to our main one. Let's see. We have consumer expectations reviving, rising, declining, falling sharply. So I can say we're rising. I think that's fair to say it's rising. So again, I would put us somewhere towards here, right? Energy, consumer staples, and healthcare. That kind of makes sense to me, right? So we're rising, looking pretty good. I would put us probably right about here. So far too, we have full recovery and rising. So I put us somewhere in the middle, okay? Right about here. Next is industrial production. How do we find that? Well, we have this beautiful thing called a GDP. So as the country produces more and as every American produces more, you gotta track GDP. And so what we're gonna do is come here. Now, it depends on what time frame you wanna look at. I personally go with 1 year, 5 year, 10 year, and 6 month. I think it depends on your preference of how long you'll be trading for. If you're gonna be trading off of the 5-day, 15-minute chart, you may wanna look at a smaller time frame. But again, I think the macro makes way more sense. And so I think you should be looking at 6 months, a year, 5, 10, and everything like that. So over here we have the max, which is not going to be very, very helpful. But again, let's go to 1 year. Well, on 1 year, we can see that it's what? Declining. Now again, we're still producing more. And we're still producing, positive as it goes on. But 5 years, we can see a much clearer picture. We're going up, GDP is rising. And now since July of 18, it's been coming down. 10 years, it's much of the same. So we're still producing something. We're still having positive, but it's definitely coming down. So let's go back to our chart over here. It's not bottoming out. If it was bottoming out, we'd definitely be near like -4, -2%. Rising, wouldn't say that. Flat, you could argue. It's probably getting kind of flat, but I'd argue it's falling. That's just me. So I definitely put us again in, I would say falling or flat would put us somewhere over here. And again, we're going off the blue line here, so we're going to be going at falling. So we're going to put ourselves utilities, financials, and real estate. So again, we had full recovery, which would have put us kind of over here. You know, rising, putting us kind of over here again, but now we're falling, so I'd put us kind of over here, right? We're having early recession signs. We're having, you know, again, just go through it. Full recovery, I'd put us kind of right here. All right, maybe a little bit over, right? We're rising, okay, I'd put us somewhere, you know, somewhere over here, and then falling kind of over here. So we're kind of, again, flirting with energy to real estate. Any of these kind of sectors is what we're kind of flirting with. Interest rates. How do you find your interest rates? Let's go to this link right here. Look at that. Now, I wouldn't always use TNX as the greatest one, but it is important to watch this to see what it's doing. So you can come scroll through and we can see, you know, that the interest rates have been kind of dropping steadily, which is a good thing. And you can come look at the numbers you want to. I'm not really a numbers guy. I'm much more of a graph kind of guy. So let's go 3 months. We can see over the last 3 months, the interest rates have been rising. And again, you can go to Thinkorswim and type in TNX, and you can see that they've been rising. And I've been charting these with the Discord group and all that. So they've been rising steadily, right? Now we can come back and we can look at 6 months, been rising. A year, been rising. 3 years, was dropping, but now again, rising. So I think that's plenty of evidence for me that it's been rising. Let's come over and see that they're not falling. They're not bottoming out, rising rapidly. Makes sense to me. Putting us at full recovery, again, right here. Consumer staples, energy, healthcare, utilities. These are the 4 I'll be focusing off of this one. And last one is the yield curve. Come over here. What is, oh, that's good. Whoa, big fellow. Oh, right. Good mouse. What is the yield curve? And again, if it's going to be negative, and you're going to, this is a whole bunch of nonsense you don't really even do at this point. But if you were to look at yield curves and they become negative, so this is what it should be looking like, positive, you're good to go. Now, if you were to come over here and add months to it, you can see that it looks pretty good, yada, yada, yada. As long as this bad boy is not negative, and I mean like if it wasn't actually pointing down, you're okay in the yields curve. So that looks pretty good. I think March 2020, nope, that's even positive. There it is. February is a bad one. See how February is coming down? You don't want that. Everything that looks good and positive is a good month for it. So as of right now, it's still rising. And so I would say it's normal, but I can say it also is flattening out. So you can see all of these are definitely in 2021, where we are now. You know, let's see, let's delete all these. So May, all right, you know, it's flattening a little bit. April, not really new, obviously. March, flattening. All right, so they look pretty normal. But I definitely wouldn't say that they are steep. I'd say flattening out right now. They're, you know, normal, flattening out anywhere in here, which again puts us where? Right in this area. So what am I getting at? This is going to take you 5-10 minutes once a week. If you really want to check in these kinds of things, you can look at it maybe once every 2 months, every month. But again, this is a gravitational force. All we're doing is we're going to decide what sectors are going to be up next to be bought into, because there's a thing called regression to the mean usually. And as these stocks, again, as we saw 365-day average, even 270-day average or 200-day average, these stocks, the energy was overbought, materials are overbought, all these are overbought. That means that these 6, consumer staples, healthcare, utilities, financials, and real estate. Well, financials always do really well, again, because folks buy stuff in times of crisis. These 5 are going to be up next, right? If you can see that with these averages, they're all now outperforming than where they were, right? 180 days, again, negative 13 for utilities to now plus 2. It's a 15% gain. That's crazy on the whole entire market. We can see that energy was plus 15, and now it's only plus 7, so it's negative 8. So you can use this to make better decisions. I don't mean like you should disregard technology completely or disregard materials completely or discretionary completely, but again, we're moving towards a bear market / a late bear market. I don't mean the whole entire like, oh God, it's gonna be dropped 20%, oh geez. No, I just mean folks have been watching utilities drop, consumer staples drop, healthcare drop, they've been watching real estate drop, and financials have been going crazy for whatever reason. So now folks want to buy these. What you can do lastly is also this. So the last thing I'll leave for you guys while you do this is sector charting. Sector tracker is pretty good. It's going to show you every single one of these sectors. Now I'm going to do a year. I think that's pretty good. So we can see that consumer services XLC. If I were to go to Thinkorswim and type in XLC, it's the exact same chart. And again, that comes down to preference. And you can chart these technically. I'm not the most like, hey, chart your sectors technically kind of guy. You certainly can. Like I think whichever one the technology one is, and again, there's a lot of them, so I get confused. And XLK is a great example of what you can do. So XLK, you can see it's a super nice channel up. And I mean, you could be like, well, it doesn't apply. I don't like technical analysis. Yeah, you don't have to like it. I mean, you don't have to do it. It's up to you, right? But I would definitely, looking at this, I would definitely be buying technical analysis. I would definitely be buying my tech stocks at 130. And so you can set an alert like this. Hey, when this is at or below 129.95 next time, I guess you might want to raise it up a little bit, right? Like right to there. Right, that's fine. And then next time this does come down, beep, and it alerts you. Now you can know that technology stocks as a whole are on sale. And then you can buy into them. And again, this is much different looking than the energy one. You can look at the energy, which is going to be XLE. Look at this. It's definitely up cruising a little nice here and easy to chart. But again, let's go to 10 years. Energy is crashing off while technology is taking off. So again, these sectors are not built equally. And again, this should not be the final say off of what you're doing. But again, it sheds some light for you. So, we can do like the last 5 years. We can see that, as it started, communication services taking off. Consumer discretionary, like folks buying shit they don't need, taking off. Consumer staples, flattening out. So again, you can look at all these and compare them. And what's the main goal of this? Again, you can see which sectors outperform other ones easily. And again, this may get kind of convoluted quickly for some people who are new to it. But we can kind of track and see which ones are going to be oversold and overbought. I don't mean like in the RSI traditional, like, oh, we should definitely avoid technology because it's so far up there. Well, no, technology is definitely showing that it has the greatest potential. But then again, we can see at the bottom here, the discretionary, no, which one is that at the bottom? Should be energy. Yeah, because the energy has just been tanking hard. So again, maybe energy is a really good deal. But also maybe, this is where fundamental analysis comes into, maybe it's because coal and that stuff is not working as well, and solar and wind are taking over. Maybe that's not as lucrative, and folks are leaving it. Maybe the EV market's going to come back and really push energy, and you can get a great deal. That's where you come involved with fundamental analysis. So what I like to do, again, is use my sector rotation. And so I'm going to come over here, and I'm gonna personally say for us right now in April 2nd, 2021, we're facing a bear market. And again, I do not mean it's going to pull back 20% and you should sell everything. I'm just saying that these 5 sectors, consumer staples, healthcare, utilities, financials, and real estate should outperform the market in some aspect. And I don't mean everyone's going to do it. I'm just saying that these 5, if the market tanks, will probably tank less. And the fundamental reason is people buy shit that they know and that they need. And especially with like healthcare, for example. If you need insulin, this is again a micro level example. If you need insulin and it costs $5, you're going to buy it. If it costs $10, you're going to buy it. If insulin costs $1,000, you're going to buy it, right? And the same goes for utilities. If you live in a house, electricity is $100, you're going to pay it. If it's $200, you're going to pay it, right? Same with financials. You're going to put your money, a bank. And when the real estate kind of crashing now, these are going to go on sale pretty quickly. Could be great. And again, consumer staples, things you understand, things you know. Those, the Dow Jones top 30 industrial stocks, right? Home Depot, you know about it. Boeing, you know about it. Walmart, you know about it. Target. Places you shop at are going to do much better than technology, because in times of the market kind of peaking out and then coming back down, folks don't really buy technology. They're not going to buy communication services, those kinds of things. So again, I'm going to put my money on these 5 sectors for now, based off of what we talked about with these 5 things you can go and look at. And then again, I'm going to come over to my chart. And again, I won't tell you that you have basic materials, SBI. I'm going to look at the 10-year, maybe the 1-year charts, whatever it may be. And I always think that these sectors are going to be pulled back to regression and means. And so what I mean is that as these charts go up, I want to kind of put a line in the middle. And this is my personal what I like to do. Put a line in the middle where I think half the action's above and actually half the action's below. So I'll go with probably right about there. So half it's above, half is below. 9 out of 10 times in most of these sectors, they're going to get pulled back to it. And so as we can see right now, I think that the materials, a bit overbought. That's fine. XLC, we can see it's not been around as long. Probably just something like this. And again, we can see that it's, a little bit up there. XLE, our energy, has been tanking off. So again, I would definitely draw a trend line of some type down here. It's up to you, and you could probably buy energy stocks down here. Now again, if there's a huge shift to like different types of energy and it takes off, you know, all of it's out the window. It breaks above that. XLF are this should be finance, I believe. I can look into it. No big deal. Draw a line probably in the middle. And so what I'm getting at here is that I think most times you can buy most of these stocks on whatever time frame you prefer, whether it's going to be the 1 day, the 5 day, the 15 day, the 5 year, whatever you want to use for your gauge of how far up you are and how far down you are. You can start to kind of time your entries better. And I can do a whole section on larger indexes and using the SPY and the Dash ES, whatever it is. But again, you must start to think about this, especially as we get in the more choppy market. Are you going to keep buying technology stocks when technology is down 4% overall, while financials are up 19%? Like, why would you try and swim against the tide? And these are things that I'm not the brightest bull in the bull drawer. I mean, look at me. And even I can understand this. So again, my final words of wisdom for you is that anybody can do this. If you were to go ahead and look at major indexes first and see, all right, do we look oversold or overbought on the major indexes? And again, it doesn't always come back to regression of the mean instantly. And what I mean is if you draw that middle line, it doesn't always come back to it instantly. But again, we are really off. We are really far up there. I mean, if we look at like S&P again, we are overbought. Horde. We are up here. And again, I think that a good regression line would be somewhere around here, maybe about there, you know, about half above, half below. And we are a good, what does this look like? A good 21% up there. Again, so it's pretty crazy. Chart that with like XLK, the technology one. Again, that's pretty far up there, my boy. I think that's probably a good regression line. Anywhere in here is probably doable. And again, it depends on your time charts, but I would definitely be remiss not to mention that I think we're a little bit high up there. And again, the whole point of this video was for you guys to watch it, understand sector rotation, and those links will be down in the description box below. If you guys need anything, let me know. But that's how I find the sectors that I like to focus on and why I usually do pretty well on my watch list. If you guys need anything else, please let me know. Otherwise, have a good rest of your day. We'll catch you guys next time. Thanks.